You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Good morning, Jim, and good to be with you.
All the boards across North America are in the red and deeply in red as we speak. What's happening?
Well, yeah, the opening was steady, and then it slipped down, held for a bit, and then now making new lows. This is setting a bear market. Now, in the last decade or so, with the talking heads on TV, there's this notion has come up that a bear market is a 20% drop. So then you can't decide until that it's a bear market until it's down 20%. It's pretty naive. Now, for us, what we did early last year was note that the high in the senior indexes like the Dow Jones was not being confirmed by a high in the transports. That's the old Dow theory. And I can't remember whether we ever used it or not, but it looked interesting. So we followed it, and in February, actually with Valentine's Day, put out a special on it, noting that this is a heads-up situation. So then you had pretty good momentum and stuff like that going into May, and we did a countdown, like as seasonally the market was up, so we said, yeah, is it up when it should be? Yeah. Are there signs of speculation? Yeah, there was, and then particularly in Shanghai, where, like at the first of the year, you couldn't quite say it would bubble, but by the time you got to March, and it was giving signals that it was incredible. So then historically we used the previous bubbles completing generally in June and said, okay, here's the probability. And then on the Shanghai market, we needed to have a cluster of upside exhaustion readings. We had two as it was lifting off, and then what we needed was the third cluster of exhaustion readings and upside exhaustions, and was only one came in early June, and we figured, hey, that's enough. And then that was the high in the Shanghai market. So it got hit in August. It took everything else down with it. But, the market had turned to widening credit spreads anyways. We used that as backup, that there was a problem growing. And in July, to compare to what happened in 1998, you needed to have the trend in credit spreads break out beyond the previous high, or we should say widening. And you had that by the first week in August. So we flashed that. And indeed, it all came apart and became exceptionally oversold in August and September. And then you had bounces. Now, my colleague in the chart works, he had a high range for the bounce and the Dow Jones average, and the bounce did actually exceed that high band by 100 points, but hey, that's pretty good. Then in the work I was doing on momentum, up to the 50-day moving average, it almost made it, but it did try, so it stayed within the 1998 pattern on the rally until recently. So now things are failing dramatically. In December, you did have the second breakout in spread widening, which then has pushed off this exciting year. Also worth noting, Jim, is that where the first week was very heavy, and people said you've never had a year-end opening like this since, the Dow began. But that was a distraction. It had nothing to do with the year-end or the opening week of the year. It was just that in China, they also put on stories about the policymakers having these limits, like down 7% and then changing that. But the nub of the story is that there were more offers, there was more stock on offer than there was bid for. So it had nothing to do with the stock exchange people who are running it. They're just being overwhelmed by history. So anyways, we were going back to our good old transports index, which gave the real key non-confirmation at the May high, and then it went down, and quite a few weeks ago, it took out the lows of August, September closes, and it also took out the October 2014 low. So we said, and I think it was down 14. The Dow was down 14% at that time, and said the failure in the transports and where it's leading says, hey, this is now a bear market. Whereas our advice in the summer was that the bull market had ended. So this was a key transition, and it had nothing to do with 20% because it was down 14% then, but it was the failure and the failure with widening credit spreads and weakening commodities. So here we go. You can have a seasonal low for crude oil in December or January, and it's working on it now. We're down below 30, and we did have two targets. One would be a decline in crude oil prices to 1/3 of the high, which we calculate out as 37. Well, it spent some time there. Then the other would be to 1/4 of the high, which number seems to be around 27. And this isn't technical research. This was just a round number target. Who knows, maybe an annual average. But it's heavy duty, and the energy market in crude oil is undergoing a technological revolution in base metal mining in the early 1900s. Prior to that, it had been all mainly high-grade vein mining. But in 1910, down at Bingham Canyon, just south of Salt Lake City, was a large copper porphyry system, and people figured out that we can make this work on a large-scale production, and indeed. And Bingham Canyon, more than 100 years later, is still operating. So that was the efficiency development in base metal mining. And then in the 1970s, you had a technological breakthrough in gold mining, where at Carlin, Nevada, you could mine low-grade gold rather than just high-grade vein stuff. And then also that was when the heap leaching came in as well, and that was a revolution in gold mining. And now with petroleum in fracking, that's the technological revolution, and this has changed the petroleum world forever, and it's going to be a benefit to the consumer. But going back a year when we were looking for crude oil to go down, and well, actually, no, longer, yeah, but it was summer of 2014, and the crude did start going down by that September, and analysts said, oh, this is great because gasoline will go down, and that'll put more money in the hands of the consumer. So they were looking at weak crude oil prices as a benefit, but the point of view was that crude would be weakening with other commodities, and that would be suggesting a weakening global economy, and that wouldn't be so good for most anybody who wanted a job. So, hey, it's a bit of a bleak day, isn't it?
Well, I was going to say, too, with the downturn in oil prices, all these people have lost these $100,000 a year jobs, and now they're making sandwiches at Subway. Hardly, the same kind of wage scale.
Yeah, it's and particularly when you have a province like Alberta, where energy has been such a large factor in their economy, and you just read about it. It happened very fast. Real estate, no bid, all sorts of problems. And then, of course, you've got a socialist government in there who is deliberately trying to make things worse because they have a certain image of way things should work. So, anyways, what we are looking at now on the crude oil, say you can have a seasonal low in January. We're halfway through. So I think the immediate pressures here are close to maxing out. I mean, this is getting to be a slaughter in stocks and junk bonds and in most commodities. So, but it's a falling knives situation, so we're not advising anybody to go out there and try and catch the bottom. We're just trying to say that this is now so intense that maybe in 2 or 3 weeks' time this could culminate and some relief would come into the markets. In the meantime, it's confounding the policymakers all over the place because they're still going on about, they're providing stimulus, and also, by the way, what's going on in the credit markets had nothing to do with the Federal Reserve boldly raising the discount rate from infinitely low to one tick up. Nothing to do with that. This is just straight baked in the cake change in credit spreads and change in commodity prices. So somewhere in the next few weeks there could be some stability. Now, It's interesting that today gold and silver are doing okay, but they sort of got hit. So it's still not a market where you can figure that you can get a bull market for gold and couple of months ago, did accumulate a few gold stocks, and they had a bounce, but they're giving it up again here now. We would wait for another opportunity before adding to the position. So it's one of those markets where there are very few things that can withstand the storm.
Well, auto sales were strong last year. They expect strong auto sales again this year because of the low energy prices. But these are 7 to 9 year car loans. Is that going to come back to bite the banks?
Oh, I've been looking at U.S. car sales for 6 months thinking somewhere this has got to top, especially when you have credit spreads. Well, the spreads don't really affect it. The main thing is, can the automobile dealers still go through with the story about zero interest rate costs? But somewhere the buyer of in the U.S. and Canada as well of light trucks and automobiles. I mean, in the U.S. you can see the actions are still buying pickup trucks like there's no tomorrow. So somewhere, as with any market phenomenon, that will conclude, and it's beyond my ability to say when. You've now got a financial storm. Whether this gets through to the car buyer well, it will at some point, but we don't know when. But when those automobile sales, let's call it a buying frenzy, ends, it's going to have a very dramatic consequence with everything slowing down. And then, of course, you got crude oil being stored in tankers, and they're just circulating around or parking. Actually, there's an interesting little thought there. All that crude oil in those tankers displace a lot of tonnage. Maybe a tanker is 80 or 100,000 tons displacement. I think that'd be raising the sea level all around the world. It's a scary thought.
The thing is, the tankers, whether they're full or empty, are still out there.
They're still out there, full of oil. So, as a financial historian, Jim, this is fascinating to see a technological revolution come in and so dramatically affect the energy business. It's so great to be here and noticing it as it goes by.
Well, if people are going to start driving or not driving those robot cars, in Los Angeles the other day, one of those cars went nuts and started driving in circles, and they had to take it out with the police.
Oh dear. It's like somebody when they fall out of a powerboat and it keeps going around in circles.
Well, same thing there. They're trapped in their car.
Oh, yeah, yes. Anyways, there will be, I guess, with robot cars, there'll be disasters until they get it all sorted out. But, I like driving. I can't see being driven around by a robot.
Well, we both like sports cars.
Yeah. Oh, yeah.
And I said, look, you're not going to spend $200,000 on a Lamborghini to let a robot drive it.
No, but a friend of mine up at Whistler Mountain skiing a couple of weeks ago told me he saw a recent Lamborghini with a ski rack on it, with skis on it. And I thought, oh my gosh, that is the ultimate. Probably cost $5,000 for a Lamborghini ski rack.
Well, the good news is if it flips upside down, it'll slide down the hill.
Oh, well, there you are.
Bob, with things sliding, is there anything that's doing well right now?
Well, you can say that gold's up today, but no, and there's lag stuff in here, Jim. It's a good question. When does it get high-end real estate in the financial capital, which has had a huge bid right until the latest number I saw before Christmas? And then, of course, you got the unique bid for real estate in Toronto and Vancouver. How long does that last? And this pressure in commodities is immense. And eventually it'll get the real estate, but in that one you can't sort of say when, but maybe it's worthwhile taking a look around to see if there's anything, a precursor of the end of speculation in, as I say, high-end properties in the financial capitals, London, New York, and then you've got the phenomenon in Canada with Toronto and Vancouver. So we'll see.
Bob, yes, as they say, we live in interesting times.
We do live in interesting times, Jim. And it's a privilege to be conscious through this, and then also an additional privilege to be able to comment on it. So thank you very much.
My guest has been Bob Hoye. He's the Chief Investment Strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. You can forward questions for Bob or comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.